15 minutes. That is how much time separated one of the most suspicious trades in modern financial history from the announcement that turned it into a fortune. $580 million in call options on the S&P 500, placed on the morning of April 9th, 2025, while markets were in free fall and every analyst on television was telling you to brace for impact. But here is what the headline does not tell you. The part that made professional traders stop mid-sentence when they saw the data. Those options expired at the end of that exact same trading day. Not next week, not next month, that afternoon. Whoever placed this bet was not wagering that markets would eventually recover. They were wagering that markets would explode upward before the closing bell on that specific Tuesday. And then, 15 minutes later, Donald Trump posted to Truth Social, announced a 90-day pause on most global tariffs, and the S&P 500 surged 9.5% in a single afternoon, one of the largest single-day gains in the history of American markets. The trade printed massively. And the question that has been rattling around Wall Street, inside the SEC, and in every financial Reddit thread since that day is the same question you are already asking right now. How do you know something like that 15 minutes early unless someone told you? I want to walk you through exactly what happened, how the trade worked, why the timing is so damning, and then I want to show you something even more uncomfortable. Because this is not actually the first time something like this has happened around a major Trump policy announcement. There is a pattern here that goes back years, and understanding that pattern changes how you see everything that happened on April 9th. There is also a subplot running through all of this, a quieter story happening in parallel that I am going to come back to near the end. It involves the one institution that is supposed to prevent exactly this kind of thing from happening, and the very specific reason it often does not. But first, let me set the scene. Because to understand why $580 million in same-day call options is so extraordinary, you need to understand what the market looked like in the days leading up to April 9th. It was ugly, genuinely stomach-dropping ugly. Trump had spent the previous week announcing sweeping tariffs on essentially every major trading partner the United States had. Liberation Day, he called it. April 2nd, 2025. The administration rolled out a tariff structure that most economists described as the most aggressive trade barrier erected by any American president since the 1930s. Not a targeted tariff on a specific product or specific country. A broad, categorical, across-the-board restructuring of how the United States taxed imports, with rates on some countries going as high as 145%. The markets, which had spent 2 years pricing in a relatively stable geopolitical environment, absolutely lost their minds. Between April 2nd and April 8th, the S&P 500 dropped roughly 12%. The NASDAQ dropped more. Volatility spiked to levels not seen since the early days of the pandemic. Trillions of dollars in market capitalization evaporated over the course of less than a week. Hedge funds were unwinding positions. Retail investors were panic selling. Margin calls were going out. The financial press was using words like crash without feeling hyperbolic about it. Even normally unflappable institutional voices were putting out research notes that used phrases like heightened uncertainty and risk-off environment, which in the genteel language of Wall Street research translates roughly to, we have no idea what is happening and neither does anyone else. This is important because it sets the psychological backdrop for April 9th. By the morning of that Tuesday, the consensus view among professional investors was not markets might go up today. The consensus view was closer to we are in a sustained downturn driven by trade policy uncertainty that is not going away anytime soon. Goldman Sachs had raised its recession probability estimate. JP Morgan had published a note warning clients about the risks of prolonged trade conflict. The mood was defensive, protective, cautious, which makes what happened in the options market that morning so statistically extraordinary that it is difficult to overstate. Let me explain how these options work, because the mechanics matter. A call option gives you the right to buy something at a set price on or before a set date. If the thing goes up, your option becomes more valuable. If it does not, the option expires worthless, and you lose everything you paid for it. Zero-day expiration options, which traders call zero-day TE, are call options that expire at the end of the current trading day. They are extremely high risk extremely high reward instruments. They are the financial equivalent of putting all your chips on a single roulette spin at 3 in the afternoon when the casino closes at 5. You either multiply your money dramatically in a matter of hours, or you lose everything by sundown. Zero DTE options have become enormously popular in recent years among retail traders who like the adrenaline and the speed. But $580 million is not a retail position. $580 million in zero DTE S&P 500 call options is one of the largest single-day directional bets anyone has placed in living memory. The S&P 500 options market is deep and liquid, one of the most actively traded instruments on Earth. And even in that market, a $580 million same-day call position stands out like a foghorn in a library. Traders who monitor unusual options activity for a living noticed it almost immediately. It hit the tracking screens. People started talking about it on trading forums and financial Twitter before noon. And then, a few hours later, when Trump posted his tariff pause announcement and markets launched upward like they had been fired from a cannon, those same people watched in something that can only be described as stunned, jaw on the floor disbelief. Because the timing was not close. It was not a matter of, well, someone got lucky and bet big that morning. The trade was placed approximately 15 minutes before the announcement. 15 minutes. In options market terms, that is essentially simultaneous. No one was sitting there doing fundamental analysis and concluding that markets were due for a 9% rally on April 9th specifically. No chart pattern predicts a 90-day tariff pause. No technical indicator flags a Truth Social post. No algorithm trained on historical price data spits out, buy everything today because the president is about to change his mind on the largest trade policy restructuring in a century. 15 minutes before. I am going to come back to the profit number in a moment because it is enormous. But first, let me introduce you to something that makes this whole story even more uncomfortable. And it is the thing that very few people were talking about in the days after. This was not the first time. There is a pattern of unusual options activity appearing before major Trump policy announcements that goes back to his first term. And I am not talking about one or two instances that could be dismissed as coincidence. I am talking about a documented, repeated, statistically significant cluster of suspicious trading activity that precedes specific policy reversals and major announcements with a frequency that defies random chance. Researchers at Columbia and other institutions have published papers on this. The SEC has opened inquiries. Congressional members have written letters demanding investigations, and almost nothing has happened. Almost. I am going to come back to the word almost near the end of this, because it is doing a lot of work. But here is where the subplot comes in, and I want you to hold on to this thread because it connects to everything. Around the same time that traders were flagging the suspicious options activity on April 9th, a different group of people were having a very different conversation. These were compliance officers and legal teams inside major brokerages and clearinghouses. Their job is to monitor for exactly this kind of activity, flag it, and report it to regulators. They call these reports Suspicious Activity Reports, or SARs. When something triggers a SAR, it goes to the Financial Crimes Enforcement Network, the SEC, potentially the FBI. The system exists specifically to catch this. It was designed for moments like this one. And the question that the people inside that system were quietly asking each other in the days after April 9th was how many SARs got filed, how fast, and then more quietly, more carefully, by fewer people. What happens to a SAR investigation when the person whose announcement may have leaked is also the most powerful individual in the United States government? That is the question I am sitting with, and I think you should be too. Let me get back to the money, because the profit here is genuinely staggering. When the S&P 500 moves 9.5% in a single afternoon, zero DTE call options do not move 9.5%. They can multiply by factors of 10, 20, sometimes more, depending on where the strike prices sit relative to the movement. The leverage embedded in same-day options is extreme by design. That is the whole point of them. Early estimates from options analytics firms suggested that a position of $580 million in S&P call options placed at those strike levels at that time of day, given the magnitude of the subsequent rally, could have generated returns in the range of several billion dollars. Some estimates put the potential profit at over $1.5 billion. Others, using different assumptions about the exact strike prices and volume, put it higher. The uncertainty around the exact profit number exists because options positions can be structured in complex ways, layered across different strike prices, different underlying instruments, different account structures that make forensic accounting from the outside genuinely difficult. What is not difficult to estimate is the probability of making this trade by accident, by pure luck, by brilliant analysis that happened to be exactly right on the single most consequential trading day of the year. Statisticians and quant researchers who looked at the activity described the probability of this timing occurring randomly as essentially zero. One researcher described it as being roughly equivalent to lightning striking the same square meter of ground twice in 5 minutes, which, to be clear, technically can happen. Probability is not impossibility. But when you see lightning strike the same spot twice in 5 minutes, you do not start recalculating the odds. You start looking for a lightning rod. Now, I want to give you some historical context, because this is where the story gets both more interesting and more depressing, depending on your tolerance for institutional irony. Insider trading is as old as financial markets themselves. The first formal prohibition on trading on material, non-public information in the United States was codified through SEC regulations stemming from the Securities Exchange Act of 1934, though the specific insider trading rules we recognize today developed more substantially through case law in the 1960s and 70s. The SEC prosecuted its first major insider trading cases in the 1960s. And for decades, the story of insider trading enforcement in America followed a relatively clear arc. Someone trades on information they should not have, they make money, someone notices, the SEC investigates, and eventually someone goes to prison. The most famous example, and the one that still defines how most people think about insider trading enforcement, is Ivan Boesky. In 1986, Boesky was the most celebrated arbitrager on Wall Street. Arbitrage, in his case, meant betting on corporate mergers before they were publicly announced. He had an extraordinary track record of buying the right stocks at the right time before acquisition announcements sent their prices soaring. The financial press called him a genius. He wrote a book. He gave a commencement address at Berkeley's business school in which he told the graduating class that greed is healthy. The audience cheered. Genuinely, that actually happened. A few months later, the SEC announced they had evidence that his genius was, in fact, an elaborate insider trading network that involved paying corporate lawyers, bankers, and executives for advance notice of pending deals. He paid a penalty of $100 million. He was banned from securities trading for life. He went to prison. The message was supposed to be that the system works, that the SEC catches this, that the consequences are real. And for a while, that message held. The Boesky case triggered a wave of enforcement that sent several prominent Wall Street figures to prison through the late 1980s and into the 1990s. The Raj Rajaratnam case in 2011, which involved the Galleon Group hedge fund and a sophisticated wiretapping operation by the FBI, resulted in an 11-year prison sentence and was widely celebrated as evidence that the system still had teeth. But here is the thing about all of those cases, the thing that makes the April 9th trade so different in ways that have nothing to do with the dollar amount. Every major insider trading prosecution in American history has involved private information. A merger that has not been announced, an earnings report that has not been released, a drug approval that has not been made public. The information that leaked was information controlled by private entities, corporations, law firms, banks, whose employees had legal obligations not to trade on it and not to share it. The enforcement framework was built for that world. The SEC has enormous statutory authority to compel testimony, subpoena records, and pursue civil and criminal penalties against private actors who misuse private information. What the enforcement framework was not designed for, what no one thought to explicitly address when writing the securities laws, is a scenario in which the information originates from the executive branch of the United States government, from the president, who has the authority to set policy, who is not a corporate insider in the traditional legal sense, who cannot technically be compelled to testify before the SEC, who controls the agencies that regulate financial markets, whose communications are subject to executive privilege claims that can delay or block discovery for years. This is a genuinely novel legal territory. And the people whose job it is to navigate it, the lawyers at the SEC, the investigators at the FBI, the congressional oversight committees, are all very carefully aware of that fact. Which brings me to the most important question in this entire story, and the one I promised to come back to. What actually happens next? Let me tell you what is supposed to happen. The SEC's Division of Enforcement has a dedicated unit that monitors unusual market activity. They have access to the Consolidated Audit Trail, which is a massive database that captures essentially every order placed in US equity and options markets, including the identity of the account that placed the order. When they see a trade like the one on April 9th, they can, in theory, pull the account records, identify who placed the trade, determine whether that entity had any connection to anyone with advanced knowledge of the announcement, and build a case. This process works. It has worked before. The SEC has successfully traced complex trading patterns through networks of shell companies, offshore accounts, and nominee holders to reach the actual human beings responsible. The key phrase there is "in theory." What actually happens in practice depends on several factors that have nothing to do with the quality evidence. It depends on political will. It depends on whether the investigation creates friction with powerful interests that have influence over the agency's funding or leadership. It depends on whether the targets of the investigation are individuals the agency has leverage over, or institutions that have the resources to litigate every subpoena for years. And in this specific case, it depends on something even more fundamental: whether the investigation leads somewhere that the current administration would prefer it did not go. Because the SEC chair serves at the pleasure of the president, the agency's budget is subject to congressional approval. And the entity whose announcement created the conditions for this trade to be profitable is the same executive branch that nominates and confirms the people who run the enforcement agencies. I want to be very clear about something. I am not asserting that the president or anyone in the administration placed this trade. I am not asserting that any specific named individual had advanced knowledge and acted on it. What I am asserting is that the circumstantial evidence is extraordinary, that the timing is almost impossible to explain through luck alone, and that the institutional mechanisms designed to investigate exactly this kind of thing are facing structural constraints that have never previously been tested at this scale or in this political context. Those are three separate observations. Each one of them, on its own, should concern you. Let me give you one more layer of context that I think changes the picture considerably. In the days following April 9th, a number of financial journalists and researchers began pulling the options data not just for that day, but for the days and weeks preceding other major Trump policy announcements going back to his second inauguration in January 2025. What they found was not a single anomalous trade, it was a pattern. Unusual options activity, concentrated in short-dated contracts that would pay off if markets moved sharply in a specific direction, appearing in the hours or days before announcements that subsequently moved markets in exactly that direction, with a frequency and consistency that multiple quantitative researchers described as statistically non-random. Tariff announcements, trade negotiation updates, comments about Federal Reserve policy, each one preceded by options activity that, in retrospect, was positioned perfectly for the outcome. None of these individual instances, taken alone, is necessarily proof of anything, but taken together as a pattern, that is where the word coincidence starts to feel inadequate in ways that should make any reasonable person uncomfortable. Now, here's the part that I think gets at something deeper, something that sits underneath the specific facts of April 9th and points toward a much larger structural problem. And this is where I want to bring the subplot back into the conversation. Those compliance officers I mentioned earlier, the ones whose job is to file suspicious activity reports and flag unusual trading to regulators. The system they operate within has a fundamental dependency that most people do not think about. For the system to work, there has to be a credible threat of consequence. Compliance systems function on deterrence. You file the report because you know the report can lead to an investigation that leads to enforcement, that leads to penalties that are actually painful. Remove any one of those links and the chain breaks. Traders stop being deterred. Compliance officers start wondering whether their reports go anywhere. The whole ecosystem of market integrity begins to erode in ways that are not visible until suddenly they are very visible all at once. The $580 million trade on April 9th is visible, extremely visible. You cannot miss it. But the visibility is almost beside the point if the institutional response is slow, constrained, or effectively neutered by the political dynamics surrounding the case. Because every trader in the world is watching what happens next. They are watching to see whether this trade gets investigated, whether accounts get subpoenaed, whether anyone faces consequences, whether the system actually does the thing the system is designed to do. And if the answer is that it does not, or that it does so slowly and incompletely and without meaningful consequences for the people involved, then you have not just failed to catch one bad trade, you have sent a signal to every participant in every market that the cost-benefit analysis of trading on material non-public information about government policy has fundamentally changed. This is the loss framing that matters most here. It is not about the $580 million. It is about what that $580 million trade represents as a precedent. Because if you can make that trade and face no consequences, then the lesson embedded in that outcome is not just learned by the person who made it. It is learned by everyone watching, and everyone in finance is watching. Let me give you the numbers one more time, because I want them to land properly. The S&P 500 surged 9.5% on April 9th, 2025. At the time, it was one of the 10 largest single-day percentage gains in the index's history. The total market capitalization added across American public markets in that single afternoon was somewhere in the range of $3.3 trillion. $3.3 trillion added in one afternoon to the collective market value of American companies, driven by a single Truth Social post announcing a policy reversal that had not been publicly telegraphed even an hour before it happened. And in the 15 minutes before that post, someone had $580 million in zero-day call options positioned to capture exactly that move. You know what is genuinely funny in a deeply uncomfortable way? The trade is so obvious that it almost feels lazy. If you were going to trade on material, non-public information about a presidential announcement, and you were trying to do it without getting caught, you would probably spread it across multiple accounts. You would use smaller positions. You would maybe wait until the announcement was closer to market close, so the timing was less stark. You would, at minimum, try to make it look like something other than a $580 million flashing neon sign that says, "I knew this was coming." The sheer brazenness of the position either suggests extraordinary confidence that there will be no meaningful consequences, or it suggests that whoever placed it genuinely believed they were making a smart macro bet based on public information. I will let you decide which interpretation you find more credible. The SEC officially confirmed it had opened a preliminary inquiry into the unusual options activity within about a week of April 9th. That inquiry, as of the time this script was written, had not yet produced any public enforcement action, any named targets, or any formal announcement of a full investigation. Preliminary inquiries can take months or years. They can be closed with no action. They can be referred to the Department of Justice for criminal investigation. They can also be quietly allowed to sit on a shelf somewhere while the urgency around them gradually diminishes. The agency has discretion at every step of that process, and that discretion is exercised by people who serve at the pleasure of appointed officials. I also want to be honest with you about what is genuinely unknown here. We do not know who placed the trade. We do not know whether it was one entity or multiple. We do not know whether it was a United States-based account or an offshore account. We do not know whether the person or people responsible had any direct connection to the Trump administration or to anyone with knowledge of the announcement in advance. It is theoretically possible, though statistically improbable to an almost comical degree, that this was a massive coincidence. Options markets are filled with people making enormous, confident, high-conviction directional bets. Sometimes they are right. Sometimes they are spectacularly, lucratively right on exactly the right day. It happens. But 15 minutes, that is what keeps coming back to me. Not 1 hour, not the day before, 15 minutes. There is a financial concept called the efficient market hypothesis, which holds, in its strongest form, that all available information is immediately reflected in asset prices. The idea is that you cannot consistently beat the market by analyzing public information because everyone else is analyzing it too, and the prices already reflect the collective wisdom of all participants. The efficient market hypothesis is controversial. Researchers debate its applicability constantly. But even the most devoted believer in efficient markets would tell you that the hypothesis requires information to be available before it can be priced in. If the information is not available until the announcement, then the price cannot have adjusted before the announcement. So a trade placed 15 minutes before the announcement, positioned perfectly for the outcome of the announcement, is either the result of someone who had access to information that was not yet available to the market, or it is the most precisely timed piece of luck in the history of American finance. One of those two things is true, and the efficient market hypothesis, whatever you think of its other merits, is actually pretty useful for helping you figure out which one. Let me tell you about something called the announcement effect, because it is relevant here in a way that most people discussing this trade have not quite articulated. When markets move on news, the movement is driven by the gap between what the news actually says and what participants expected it to say. If the market expected a tariff pause and Trump announced a tariff pause, markets would barely move. Prices would already reflect the expected outcome. The reason April 9th produced a 9.5% single-day surge was precisely because the tariff pause was not expected. The market had priced in a continuation of tariff escalation. The consensus, as I described earlier, was bearish. The announcement was a complete surprise relative to market expectations. That surprise is what generated the magnitude of the move, which means the trade on April 9th was not just a bet that markets would go up. It was a bet that markets would go up by an amount that was only possible if the announcement was a surprise. If the trade was based on genuine advanced knowledge of the announcement, then whoever placed it understood not just what the announcement would say, but understood precisely how surprising it would be to the rest of the market and structured their position to maximize the payoff from that surprise. That is not a reckless gamble. That is a calculated, precise exploitation of an information asymmetry. That is the textbook definition of trading on material non-public information. And now I want to bring this back to where I started, because I think there is a version of this story that most people are not telling. Everyone is talking about the trade as a financial crime story, as a market integrity story, as a did someone cheat story, and it absolutely is all of those things. But it is also a power story. It is a story about who has access to information that moves markets and what the actual consequences are for using that access in ways that are supposed to be illegal. Because here is the uncomfortable structural truth that runs underneath everything I have told you. The information that caused the S&P 500 to move 9.5% in one afternoon was not generated by a corporation. It was not generated by a bank. It was not generated by a research department or a laboratory or a trading floor. It was generated by the President of the United States making a policy decision. Policy decisions are not products. They are not property. They are acts of governance. And the laws governing insider trading were written for a world in which the most consequential market-moving information was corporate information, controlled by fiduciaries with clear legal obligations. Those laws were not written for a world in which the most consequential market-moving information flows from the executive branch of the most powerful government on earth, where the chain of custody is opaque, where executive privilege can shield communications from subpoena, and where the people responsible for enforcement are structurally dependent on the very institution whose information may have been the source of the leak. That is not a bug in the system. That is a gap in the architecture that nobody adequately anticipated. And it is a gap that this particular trade has made undeniably visible. The compliance officers are still filing their reports. The SEC's preliminary inquiry is still officially open. The $580 million in options has long since settled. And somewhere, someone is sitting on a profit that may be the largest single-day gain from a directional bet in the history of American financial markets. We do not know who, we do not know how they knew. We do not know whether the institutional mechanisms designed to find out will be allowed to do their job. What we do know is this: the 15 minutes that separated that trade from the announcement are not going to get longer with time. The gap is fixed. The options data is recorded. The consolidated audit trail captured every account identifier attached to every order. The information exists. The question is never whether the evidence can be found. The question is always whether finding it is allowed to matter. I have been thinking about what the right parallel is for this moment, because every financial story eventually finds its parallel in history, and this one is no exception. And the one that keeps coming back to me is not Boesky. Though the surface similarities are obvious, the one that keeps coming back to me is something older and in some ways more instructive. Before the Securities Exchange Act of 1934, before there were rules against insider trading, before the SEC existed, there was a period in American financial history when trading on advanced knowledge of major developments was not just common, it was expected. It was how the game was played. J.P. Morgan moved markets with information. Railroad barons traded on intelligence networks that gave them weeks of advance notice on developments that would affect their share prices. The floor of the New York Stock Exchange in the 1880s and 1890s was, in many respects, a structured competition between people with different qualities of information, and the people with the best information were the people closest to power. The rules changed because the concentration of that advantage became intolerable to enough people that it produced political pressure for reform. The Securities Exchange Act was not a gift from enlightened regulators. It was a response to a public that had watched the same small group of people win the same game over and over using the same information edges and decided it had had enough. I am not predicting a reform moment right now. I have no idea what happens next with this specific trade, or with the broader pattern of which it is a part. What I am saying is that the mechanism by which markets became more fair in the past was not enlightenment. It was pressure. Public pressure, political pressure, pressure from the accumulation of enough visible, undeniable, impossible to ignore examples of the same thing happening repeatedly until the silence around it became untenable. April 9th, 2025 may or may not be one of those examples. But it is the kind of example that tends to accumulate. And accumulation has consequences. Here is what I keep coming back to, and I am going to end on this because I think it is the most honest thing I can say. The $580 million trade happened in public, in broad daylight, in one of the most transparent, most surveilled, most documented markets that has ever existed. The consolidated audit trail records hundreds of billions of transactions. The options activity was flagged by automated monitoring systems within minutes. Journalists were writing about it before the market closed. The SEC opened an inquiry publicly. Every piece of information needed to understand what happened is, in some form, available. The trade was not hidden. It was the opposite of hidden. It was a $580 million announcement made 15 minutes before the announcement. And that is either very stupid or very confident. And I genuinely cannot decide which possibility scares me more. The compliance officers filed their reports. The SEC is asking its questions. The consolidated audit trail has the account numbers. The system is doing what the system is supposed to do. The only thing the system cannot do, the thing that has never been built into its architecture, is guarantee that the answer it arrives at will be allowed to matter when the answer becomes inconvenient for powerful people. That is not a design feature. That is the design's oldest flaw. And on April 9th, in the 15 minutes before Truth Social post turned $580 million into something considerably larger, That flaw was not just visible, it was performing.